capital markets have been surprisingly resilient over the last few months, given the amount of bad news that they've had to digest. We've had disappointment on growth, we've had disappointment on corporate earnings, and we've had an escalation in geopolitical tension in the Middle East and the Ukraine. So put all those factors together, and it's quite surprising that equity markets are actually up year on year, although in sterling terms, because sterling's been so strong, that has certainly curtailed capital appreciation in many markets. When we look at global equity markets in general, then I think it'd be fair to say that valuations are high. They're high in absolute terms, they're high in relative terms because we've had a very strong 5-year period. And we do know that the quality of the earnings growth has not been good. A lot of it has been through share buybacks and financial engineering. So looking for value at a time like this, you have to be very careful that the profits you expect will be there. And in certain areas, such as minerals, such as oil companies that have been left behind over the last few years, we do find pockets of value, but you have to look pretty hard at the moment. Most of the transaction activity for Murray International this year has been in fixed income. We got the opportunity earlier in the year to increase exposure to emerging market debt. A lot of those bonds sold off in the February-March period, and of course there's been widespread currency weakness in emerging market currencies. So for the first time since 2008, we've been able to increase the exposure there, and by doing so we've reduced the equity gearing of Murray International from about 106 to 102 now, so much more defensive than it was before. I think what the majority of people remain concerned about is still the lack of growth in the world, lack of growth in the UK and in Europe, and of course in Asia and emerging markets are going through a cyclical downturn as well. Add to that the fact that people are worried about interest rates going up because they've been so low for so long, then it's unusual that equities are as high as they are. So we have to be very careful again in that backdrop, because the thing that worries us is the outlook for profits. We've seen a lot of high-profile profit warnings recently, so you really have to be confident that the companies in which you invest can deliver the earnings. It's always very difficult to predict the long-term outlook for equity markets because there are so many different equity markets operating in different cycles. What we do know, the starting point, is that many markets are very expensive at the moment and they've had a very good run over the last 5 years. But of course there are some other areas, such as the emerging markets in Asia, that have underperformed developed markets for nearly 4 years now and look much more attractive on a valuation basis, and also that there are room there in these areas for earnings to surprise on the upside at some point going forward. So we just have to remain vigilant in the near term, but if companies deliver over the long term, then the upside in share prices should take care of itself.